How do you actually decide how to invest your money?
Shares, ETFs, investment funds, real estate, what suits you?
And how do you build up a smart investment strategy?
That's exactly what we're discussing today. We'll look at how you can really get into investing.
If you're wondering why you should start investing in the first place, then it's best to begin with the investment basics here.
So let's get going. It's nice to have you with us for UBS Finance 101. I'm Danny, and today we're going to show you not only how to invest your money properly, but also in a structured way.
And I'm Vanessa. Look, the perfect timing for investments simply doesn't exist. That's because investments are dependent on so many factors. We can't influence ourselves. But if you adopt a structured approach, you're off to a good start. Are you familiar with the term free resources? If not, then go back and watch our first video on investing. Today, we're building up precisely these free resources. And the question is, what's the best way to use your free resources?
The answer depends on your strategy. This in turn is based on three factors: the investment horizon, your risk profile, and your goal.
The best thing is to ask yourself, would you prefer to increase your assets slowly, but surely, or take a little more risk for higher profits? And above all, are you actually in a position to take a slightly higher risk?
Let's look more closely at the main asset classes. Shares, that means investing in companies. The risk is higher, but there are also higher potential returns. Bonds. In principle, bonds are loans to countries and companies. That makes them more stable, but they also generate lower returns. ETFs and investment funds. They are wide-ranging, simple, and ideal for beginners. Real estate funds. These are investments in real estate projects. You could say concrete gold.
It's important to get to grips with the asset classes you want to invest in so that you really understand how they work.
Diversification refers to spreading the risk, not putting all your eggs in one basket. But what does that mean in specific terms?
Here's an example. For a good diversified portfolio strategy, you should invest not only in the manufacturers of umbrellas, but also in the manufacturers of parasols. Then your investments will never all decrease in value at the same time, and you'll be well prepared for any weather. And now for the most important rule, keep going. By making regular deposits, you not only stabilize the situation, you also avoid simply chasing the best rate. In the long term, over an investment horizon of 10 years or more, regular investment in investment funds and shares leads to a much more favorable purchase price on average.
That's called the cost average effect.
Your strategy depends on your goal, the risk, and the investment horizon. Depending on the asset class, you also have to contend with different risks and opportunities.
Diversification means less stress and more stability. Regularity is the key. It's better to start small than not at all.
So now you've taken the next step on your investment journey.
Do you still have questions? Post them in the comments or check the info in the description below.
And don't forget, subscribe so you don't miss the next videos.
Ciao!